The US debt ceiling. This is something that everybody is going to be discussing over the next month. But did you know that credit default swaps have now returned almost to 2008 crisis levels? Yes, this is for the US debt. Basically, people are worried about it. And as you would know, in 2023, credit default swaps mean a lot. We saw Silicon Valley Bank, Credit Suisse, and many other banks come under a lot of pressure straight after we saw spikes like this. Is the market wrong, or is it actually preparing for something a little bit worse than we think? Well, let's take a look at credit default swaps along with the data coming in for something a little sweet. We've got some good stats coming up in today's show. Let's talk stocks, commodities, and cryptos. Well, welcome back everyone to the Daily Show where we talk about stocks, commodities, and cryptos. Welcome. If you're a first-time viewer, subscribe, smash that like button if you find value in today's video. We'll be talking about the news, the macro, and of course, the hottest charts moving forward. Let's talk now, though, about credit default swaps before we get into our inflation thoughts. Yes, they're spiking, and it's something that I haven't seen before since the global financial crisis. The US debt is literally spiking across the board like a Credit Suisse or Silicon Valley Bank style situation. And it's certainly not being priced into the markets right now, similar to what we had going on with, of course, those other banks as well. Whether it's the 1 year, the 5 year, the 6 month, they're all spiking. Let's take a look at what I shared over on Twitter, which you can see here is a huge spike on the 5 year. And that's getting close now to the top of the financial crisis in 2008. So what does this mean for you? Well, we just need to know that this event is going to be relatively serious, and therefore we are going to have to pay attention to it more than we thought, because we're probably not going to make a deal before June 1st. And if that happens, then all of a sudden the markets might use this as a catalyst. Now, do I think it's all going to be sorted? Yes. Do I think things can get ridiculous before it gets sorted? Potentially, and we need to be aware of these dates. So all of these dates here are excellent, and this is, of course, a share from Pepperstone. So overall, I think that it's a clear kind of risk now based on the credit default swaps going up. Is it something that we should be super fearful of? No, not in general, but I like to know when a catalyst can be used, and it looks like this one will be used more than last time this happened, more like maybe a 2011 or 10 kind of period. So what is a credit default swap? Well, let's just take a look at a quick explanation here. 2023 is all about these, as we know. So a credit default swap is a financial derivative that allows an investor to swap or offset their credit risk with another investor. To swap the risk of a default, the lender buys the credit default swap from another investor who agrees to reimburse them if the borrower defaults. So basically, they're paying a premium right now because they're concerned that of a potential default on the US debt. Now, it's unbelievable to even, I really think that is an unbelievable statement. But yes, that's what's happening here with credit default swaps. And we didn't see them go up anywhere near as much in the other previous times. So this is certainly something that's unusual that probably not enough people are talking about. And it's just a risk to be aware of in these markets. So what about these CPI numbers? How did inflation look? Well, it came in under most people's expectations in some ways. 4.9% on the annual basis, below the forecasts of 5 to 5.25. And the narrow service measure watched by the Fed also cooled. But was it actually any good? Well, I don't think it was that good. And I'd be interested to know what your comments were down below. We saw core CPI still very sticky. This is the sticky one. So basically, we had 0.4% increase in shelter, which is continuously one of the biggest problems. Food was certainly much better. But I also noticed that we saw cars go up 4% plus over the time. That's used cars. Now, what that's telling me, and I know it's there because we can see that in used watch markets, it doesn't really matter, is that we have a huge amount of demand still in these economies. And it looks like the Fed, in my opinion, will have to hold for longer. That is, they will pivot, they will most likely hold rates here, but they should be going between that normal 4 to 6 months and not cutting. Remember, this is my kind of disagreement with the market in terms of what I believe is going to happen. And some people are starting to move across to this idea The shelter component needs to be thwarted, and it hasn't been when we take a look at those inflation numbers. So what does that mean now for the markets? Well, let's have a look at central bank injections over the last couple of days. Flatlining, not down, no tapering yet. I expect this purple line here of central banks to go down. And what this is going to do, I'll actually superimpose this on the Qs later, so you can just see how the Qs are running away a little bit from these numbers. But basically, we are still a little bit too expensive on the markets based on the central bank. And when you can look here, you'll see that this has been very good at snapping back the market later on from either an overexposed to an underexposed position. VIX 1 days were down pretty hard. This is now the VIX we're using more than the VIX normal. These, of course, are the new CBOE contract date. Make sure you put it on your charts. VIX 1D, is it worthwhile having a look at and being interested in? And let's now take a look at smart money versus dumb money flows. What's going on there? Bit of an injection here in dumb money in the last couple of days. Smart money kind of flatlining through most of this. I'd be very interested on Friday as well when I get my new updates on money flow from the big hedge funds and big money managers. Once that comes through and I do the weekend video, make sure to be paying attention because we'll see whether they've actually started dumping or whether they're still buying in on these potential breakouts this week. All right, let's talk some data. And I think whenever we're talking about this, we need to be going through the idea of whether we've got pessimism, optimism, or neutrality in these markets. So we're seeing a bit of optimism in two particular contracts, cocoa, and then also sugar. So basically some sweet sectors. Let's look at some of the information we can get from this. Well, we're getting some rare reads. Now, most of you probably don't trade these particular instruments, and fair enough, these are scary contracts, but only 4% of the time do we get reads like this, and the annualized returns is negative 9.6% when we get these reads. We go through here and we look at cocoa, and it's only 4% of the time again. Most of the time it's not in these boundaries. You can see here we're above 70 by a lot, negative 31.1% annualized returns. So the annualized returns are looking pretty bad for those sweets. And of course, a company that might suffer from this type of movement is potentially Coca-Cola. And you can see the stats really show that this is a fairly interesting play over the 2, 3, and 6 month periods. Look at Coke, negative 4.3, negative 6, and negative 7.8, only 38% of the time bullish. So one of those pretty negative stats coming in. And of course, when you take something like this information, and you can superimpose it onto technical analysis and other reasons, remember, it's all about having as many reasons as possible that are separate to make a better idea of confluence. Well, it's something that I thought I'd bring to our attention. Let's talk about dot plots. We know that this is the Fed last time we saw it versus, of course, the market, which is here. The market is expecting the rate cuts. The Fed is sitting basically flatlining, saying we're going to hold rates above 5% for the rest of this year. This is the biggest part other than central bank flow, I believe, for the rest of the year. So we'll be following that as much as we can. If you're an investor, is the market cheap? It's actually probably a little bit higher than this. No is the answer. It is high above the 16.8 25-year average. So that kind of makes you think, well, maybe it's time to just pause, wait, be patient. That's the hardest thing. Temperament is such a key component for both an investor, swing trader, or even day trader. You know, the last 24 hours in markets were like this. So if you didn't have a really strong temperament or know when to pull in the trigger, then you might have felt like it was one of the most stressful 24 hours of your time in markets. If you felt like that, let me know in the comments. I know exactly what you mean from that perspective, but it's just because when you feel like you have to trade every day, it can be a big problem. And that's human psychology. So I think the last 24 hours were a good way of really assessing the market and starting to think about it a little bit differently. This is a chart I'll update later on this week so we can find out what the biggest players are doing. At the moment, they're neutral in stance. And we'll move over now to some of the sector rotations. So here is the last 24 hours. As per usual, we've got kind of the weak stocks out here. We've got things like regional banks. We've got, of course, my most disliked sector at the moment, which is energy. And then when we had the announcement, technology stocks blew out. And we'll look at some of those, including Google breakouts and Amazon breakouts a little bit later on. Have they got more to run in them? Possibly. Let's look at the last 5 days. Again, the sectors that have been performing well continue to do okay at the moment. XLK, REITs as well, coming out very strong. People are starting to play this idea that during like stagflation, if you actually have a look, housing's not necessarily the worst. Maybe people are believing we have a huge undersupply in the US on single dwelling houses, I think. And that's going to lead in to maybe some updates. This actually has a pretty good chart on it, XLRE, so it's certainly an interesting sector. The rest of the sectors here, nothing much. A bunch of defensives up there as well. So yeah, there's no clear play, I would say, at this stage. So just before we jump into the charts and we take a look at all of the key levels we should be watching right now, I'd like to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, most of you know that one of my favorite plays in the market is Microsoft. It's pretty much my favorite stock. And it also turns out to be a pretty good AI stock if you know what they own. Overall, we have done a little bit of a special offer here with Tiger Brokers. And one of the things is if you fund with as little as 1 cent and you're from Australia, you'll be eligible to get extra Microsoft fractional shares. If you fund with a little bit more, $1,500, you'll get even more. So why do we like Tiger Brokers? Well, it's partially their upgrading of their software. Of course, we just talked a little bit about the idea of sector rotation. You can take that much further inside of the Tiger Brokers platform. And you'll notice here, if we run 10 days, look at the total 50 market cap sectors, there is a totally different tale between the markets. Regional banks are down still over 10%. Oil, one of my most disliked sectors at the moment, is down over 5%. And other markets, such as some of the big tech companies, especially after the last 24 hours of rising, have gone up a lot. Another thing that you can do inside the platform is go to the market overview, concepts, and industries. And you can actually run 5-day averages on a whole bunch of different concepts. This is something that most people don't look at. Gene editing stocks have been the best returner. Did you know that? Probably not. You might also be surprised that SPACs are up. Actually, most of these things, when they're up, usually you've got a bit of concerns. Take a look at this: Wall Street Bets, SPACs, gene editing, 3D printing, and ARK ETFs. They've been the best returners over the last 5 days, and we sometimes do see this when the squeeze is getting close to the end. So just by loading up software like this, it can really help you out. If you're interested, check out the special offers down below, and don't worry if you're not from Australia, there's plenty in there. Thank you so much. Let's get into it. All right, well, let's move into the markets now. RSP equal weighted S&P. Did it do much? No, it did nothing at all. It was all really tech running the markets up higher, which we'll look at very, very soon. XLY versus XLP, you can see there's a little bit of recovery in consumer discretionary. Now, if we believe that this market is going to be a real run here, technically consumer discretionary should be the next sector to actually have some real strength in it. It hasn't for a while, and you can see it here. If we go to XLY on the charts themselves, you can see kind of how it's trying to do this breakout. Now, a lot of you will look at this and say, oh, look at that inverse head and shoulders. Left shoulder, head, right shoulder, potential breakout coming. I get what you're saying. This is still quite depressed compared to where it has been. And if you believe the markets are really in recovery, this is usually one of the sectors that it go to after. It's still down about 31%. So it's very interesting. We will follow XLY quite a lot. What about Dr. Copper? Weakness here after the CPI number. Not through the low yet, though. I suspect, based on the way it's coming in for the third time, it's going to break and going to go to 3.7. Not good for the Australian audience out there if you like the Australian market, but we'll talk about that soon. What about high yield bonds? They were up. The market was up. I guess that's just the normal read that you would expect. US 2-year was down overall, down to 3.9. We didn't see a huge amount of shift in the forward yields. So really it was just kind of like a non-event from that perspective. Treasuries also just held their own for now, though I do still suspect treasuries may drop to 100 over this whole debt ceiling kind of debacle. Possibly it's not true. We'll be following. I am still bullish on treasuries, but I just think that 100 is there. And yeah, I mean, if you're from Australia, there's different options, a little bit more than from worldwide credit, because we have those big 4 tier banks that have pretty good bonds that pay 6 to 7%. But it's all about, you know, kind of at the moment potentially saying, is the risk of the markets worth it for the reward? And I think that's the biggest question we've got on our hands at this stage. Long leg doji from the dollar. So the US dollar, high, low, long leg doji. What could do no wrong in 2022 is certainly looking a lot weaker in 2023. You can see here what's happened. It was the big trade that everyone wanted. All of a sudden, it's down 13, and we are still stuck in a trading range. So not much to really report here. Weekly still looks poor. And I guess if we get underneath these lows here, maybe 150, I would say we're going under parity and we're moving more into the 98.63.99. That would be my target for further shorting. But we'll find out as we keep going. What about gold? Well, gold came into the zone after the news, and you can see it then sold off. Then it's rallied back up. Now, 2040 is a very important level for gold. So you can see it didn't hold above for long. This level here again, that's just reaching at the time of this video, if bears are going to pressure this particular metal, they're going to need to pressure it around this area. And then we're looking for it to probably decline a bit. Where do I think it'll decline to? Well, first up, it would be just that high 2000, maybe 2005. And then after that, the heavily traded zone of 1985. That would be a very cool level to see whether buyers could recommit. But yes, with gold, it should theoretically weaken around this stage here. And it's because we've got a high, low, higher, high, lower, low, and then we're seeing a bit of a switch. So at this stage, I would probably be more on the bear than the bull side. I've talked about that a few times. Weekly closure will change my mind. If we get a weekly closure that's really bullish here, 2040, then we'll keep going. So my midterm for gold is still, well, actually midterm next 3 months basically would usually be weak. And then if you go to the next couple of years, I'd be very bullish. So of course, as an investor, I wouldn't really have a big problem with gold. I still think it'll go to $3,000 an ounce. It's just that it might go into a bit of a consolidation around this zone unless we get a really good catalyst for it. As people lose faith, though, in the US dollar, which we're starting to see, it is the oldest currency. So some people believe that's one of the big catalysts because most of the data right now would be pointing towards weakness in gold for the next 3 to 5 months. That's usually the way I would look at it. The only caveat to that, and Druckenmiller mentioned this recently, is he's going against the stats and believing in bull gold. He's investing in it, of course, but he's going against it because he thinks people are pulling US dollars. Let's move over to US oil. Now, US oil is still hunkering down and not quite in our red zone where we expect shorts to come back in. You can see the wicks. So here's a wick and here's a wick. And I'd like to see it spike higher, then come underneath this level, then rally, then look towards the short. I'm still very negative, of course, on the energy sector for now. And that's been pretty good. I mean, we saw that all play out about a week ago. If you've been short energy sector, it's still looking pretty nasty. And not much to like about the energy sector in comparison to the others. You can't discount this type of thing happening. But yeah, I think that this is still one of the weaker sectors in the markets. Let's move over to Tesla. So I thought this thing would get to 180, and I still guess I do after it did this particular day here. It keeps flailing and failing to hold up, but look, 145 is my overall short target. For the day traders, I've been looking towards that 180, 176. And the reason to fill the gap, because it came out of the gates pretty strong on this session. It's lagged Amazon, it's lagged Google over the last couple of days. Let's have a look at the options. So we'll just refresh this moving into the end of the week to understand where the walls could be. So the 12th here, you can see there's a bit of calls sitting around 170. And I have a feeling these are maybe what's holding it down, though this options interest is nothing compared to the next week, which obviously doubles it. 180 calls. So I would like to see Tesla actually move towards the 180, then possibly move back down towards that 150, 145, fill the gap, get 61.8, finally, do what we've been looking for. Let's look at some breakouts here. So we've got a potential breakout, not quite fully broken out here on the weekly, Amazon. So Amazon's targets are pretty clean, 120 and 135. You can see I've got them pretty stacked. It does look good on the weekly. It's totally behind. A lot of people are really upset about the market running away, mostly because most people look at Apple, Microsoft. Yeah, it's good stock, don't get me wrong. Nvidia, yes, good stock. But some stocks are still down. This is down 41%. Now, there is reasons. But if consumer discretionary was to be turning, and you believed it, these are actually the ones that should outperform. And I mentioned this in the last video when I was talking about whether Google would be a false break, because of course it has this nasty looking candle, and then all of a sudden we snap it. Big day here, 4% gone through. It looks like it's a momentum style trade, and that will be interesting when we look at the squeezes, because what this market's doing is it's most likely pushing a final squeeze through, and especially on tech stocks, to try to get people, really excited about a few levels. If you think about where the markets could go to for things like this, 120 is very possible for Google. It's broken out, closed above the daily, beautiful consolidation, good basing. It does look like that's the type of thing that's broken out. Apple, I don't expect much more from this. I would think that it could spike into these highs, which is why I have alerts sitting above 176 to 177. We haven't seen a turn on this one. We haven't seen anything yet. We keep getting these little bit of concepts and maybe double tops and stuff, but it's just not enough to go off. Same thing with Microsoft, same thing with Nvidia. They're all just sitting up in those highs. Now, a lot of people are trying to buy this stock market, which is KRE. They're trying to buy this. Now, it was clear when it first came in here that it was a squeeze play. 97% of all of the stocks were sold. Obviously, that's a pretty good sign for squeezes. Do I buy KRE? Generally speaking, I would trade squeeze, but I don't think KRE is a great sector to be in. If you're going to, or if you really like this, then you're looking for these 61.8 retracement style. So usually the market comes into here, and if it's going to buy and it truly is a squeeze secondary play, that's where you'll usually expect the rallies to come from. So yeah, that would be the way I'd usually play KRE if I was going to. It's a dangerous sector. I don't think there's a huge amount extra downside, but I could also say stopping the freight train can take time. So often it does this, and then we go off. So you get more of an accumulation. So I wouldn't be too FOMO on this, but yeah, 61.8 to 78.6 fibs, somewhere in here is usually where you see those buyers recommence. A few people asked me about that one. Nvidia, still not at these new highs yet. I've got a watch reaction at 300 set just in case if we get up there. But yeah, just not enough. Still on the short here. It's at resistance where the upside is so low now in comparison to the downside component. So the risk reward makes no sense to me anymore. But obviously it's a good company, and at this stage we just don't have a turn on it. And we've said that for a while. There's no turns. We had one shot at the big short, which was in here, and it went down, and then of course we got that squeeze with the islands. Let's move over to international markets. The DAX starting off with not a great response from the inflation report. So overall, could this be a UTAD for the DAX? Question mark. We don't have enough info yet, but we will be watching this week and we'll report back. Australian market still looks pretty weak to me. Copper obviously flailing and starting to fail is not good for the XJO. So I still think this is more negative than positive, and I wouldn't be surprised at all for us to push a 7100 narrative from 7239 where we are right now. Let's move over to IWM. This is the US market. It is sitting in the middle of nowhere, doing absolutely nothing. US 2000 did come up to the short zone during the news or after the CPI news. We have PPI today, so that might show us a little bit more of a catalyst. But yeah, the markets weren't doing much. They just went like this, and it was just a bit more frustrating for day traders than anything else. Not too much insight coming from that market. This is one I want to show you though, which just shows you, remember these red lines here, as it gets darker, becomes worse for the risk reward. What you can see is there's a lot of hugging of these charts. So there were periods of time when the Qs were cheap. There are periods of time when the Qs are expensive. And we've seen a few of these play out already, and you can see it's pretty damning evidence towards being cautious at these types of zones. Now you might say, well, I don't care, I'm just going to FOMO in. Sure. But as we go through, what's driving these top 10 stocks, it's maybe their chance of lower yields, but I believe it's mostly injections. So you see the injection here, and then that pushes those Qs super hard back up. And then we get to the place that we are right now. Injection here take a look at the massive move on the Qs after that. So I don't think it's really worth the risk reward unless you're a day trader or someone that's maybe very partially swinging when you look at the Qs here. We'll go over to the futures. It's starting to get as dark as it can get. So the longer it stays in the darkness, the worse it gets. Here's the squeeze indicator. Obviously, it's like I think it's called Lazy Bear squeeze indicator. It uses a bunch of Keltners and other things, I think, in terms of the channel. But what you can see is it's switched to the squeeze as it's broken out. There's a chance now that the NASDAQ is going to go towards these levels up here, 13,500, 13,665. You might think, well, how the hell is that possible? It would most likely, if it does do that, I think it would be led by Google and Amazon because they're behind. And this is a dull market. So it's very difficult for us to try to short the NAS just yet because we don't have the information. We may have gone, okay, this could be a false break. It went down, it looked good. But then, of course, we saw using the S&P that things weren't anywhere near as good as we thought. So the S&P just hasn't been able to break out of these zones. Take a look here. Here's the S&P stuck within the range. We've still got the island reversal. You've got that big rejection wick, which theoretically is a positive sign for the markets for now. We do have the potential for pushing a little bit higher and then selling off. And we'll go through that when we look at these ES futures or this US 500 futures. So what are the most likely scenarios here? Well, I've always said if bulls took past 4180 and got a closure, they would be in control. I think the last level is somewhere around 4220. And after that, I would actually think we're going 4350 after that. So, pretty large move would be in store if we got a closure above 4220. For now, the way I see it is 4167 is still a gap fill. The gaps in here have all been filled. So we got the one that it opened with. For the private community, I was talking about the idea that we would probably come down and then buy off around 41, I think it was 19. We went a little lower, swiped it, and then came up. All of these things are symptomatic towards markets trying to drive higher because, of course, we have the wicks under these zones. Let's move over to get rid of that gap. We know the heavy trade zone is here. This is one of the toughest points I think I've seen in markets. The risk reward is relatively not worth it, even for the bear side or the bull side. It's stuck in the middle and we don't have any direction. I think we've been stuck in here. Let's have a look how many days we've been stuck in here now. So this range has been going on now for 41 days. So it's pretty much the biggest range that we have seen on the channel since maybe even starting it over a few years ago. I'm actually thinking it's getting in that zone. Yeah, this was at least wider. So it's one of the biggest ranges on the S&P anyway that we've had in quite some time. So the fireworks are going to be real. It's just, can we have the patience to react to it? If I'm going to go short here, which obviously I do have some short puts, obviously the way I do it is spreads, then I would do it for months because I just don't discount this being a real possibility. Remember, my short-term time frame stuff here is I find it hard to eliminate things like island reversals in these types of ranges. So I guess if I had to pick a direction, you'd go with the trend, which is still theoretically up. If I was going midterm, which I am, then I'd be going for lower, back into the 3750s, 3800s. And if I'm going long term, well, I think I'd be foolish to go against the market long term. And of course, I do think that even if we find a hard landing, we'll end up coming through and quality companies will be there. But I am playing with the idea that I believe this next decade of investing will be a lost decade from the US. And therefore, indices trading, like we've been, or indices not trading, indices investing could be the worst decade we've seen, similar to more of that 2000 to 2008 kind of period. Let me know what you think in the comments down below. So very tough next 24 hours to pick. PPI might be a catalyst. CPI certainly wasn't. If we keep going down smaller time frames, we don't have a new high yet. So 4157. Once we breach that, you would think we're going towards 4167, fill the gap here, potentially pull back to the heavy trade zone, and long would be one of the chess scenarios I'm thinking of. If we do end up cleaning 4100 and closing below that, I think the bears could be actually in control and we make the break to the new lows, go towards 4K 39. We just didn't get enough. I mean, these dailies just pitiful. So when you're looking at a daily like that, you're just like, well, it doesn't give us enough information. Sorry, but that's the way I kind of look at it at this stage. We do know that options are super boring this week, but I want to load up the May options for the third week options expiration. Obviously, there's always trillions at stake when we go here. So we'll go to 19th, and you'll see that we still have a ton of 400 puts. So I don't think we can get underneath 400 easily over the next week. It's just, we could get down to it. We could hover around it, but you've just got to believe buyers will be sitting there. 140,000 puts sitting there, 2.5 almost million units outstanding. There's just too many puts, decent amount of calls. Max Pain sitting at 405 though, which is notable. So that's to the down end. So that of course helps the bears a little bit in this case. But yeah, that's where the options sit. So we know where the CPI numbers are. Now we go towards the core PPI and PPI numbers. And then we have, that's on 8:30 a.m. Thursday, May the 11th. Then we have Friday, we got prelim UOM consumer sentiment. And yeah, it's all happening here. If you enjoyed today's show, please make sure to subscribe, smash that like button, join us on some of the other socials, 3 free trading cheat sheets if you're interested. And of course, check out the sponsor of today's video, which is down in the links description down below. Just remember, everybody, that temperament and sometimes, being patient is one of the biggest things. I know that sucks. No one wants to hear it, but do think back over your trading career so far and investing career. If you'd been more patient, would you have generally gotten better price or worse price? Have a think about it. Maybe let us know your comments. If there's a good one, I'll share it with the community. Thank you. Bye for now.